Hey everyone, welcome back. It is Tuesday, my favorite day of the week. I've been doing a ton of yard work this morning, so I haven't been at my computer at all. Did a couple trades this morning. It's been pretty quiet. Market was having a little bit of a sell-off this morning, but we've recovered nicely. To all those Canadians out there, I hope you had a fantastic weekend. I myself had like 4 days of just like glorious family time, way too much eating. It's almost embarrassing when you're going from like breakfast to second breakfast to lunch. And to see all my friends, I was down on the coast, so it was a fantastic weekend. So thanks for everybody's hospitality, and I hope everybody else had a fantastic Thanksgiving weekend for the Canadians that are subscribing. I see a couple people are coming on. I've got Fank on board. We've got Paul Bass watching. If you guys have any questions about anything, please drop a little chat in the YouTube chat window. I will get to your questions right away. The Tuesdays are fun because I don't do a script or anything. I just go for it. I'm just looking for things, looking for trades. And of course, everything that I talk about here is not financial advice in any way, shape, or form. It's just what I might do in my account and some of the trades I end up taking. Of course, people can find out exactly what trades I have on if they want to join the Discord. We can see that. Boy, I seriously need a shave. Let's get my face down to a different window so we can get that off, and well, let's get into what's going on in the market. SPX up 0.23%. We can see that strong bullish candle here after the weekend. We are, we're still in a major uptrend. This is a serious bull market. There's no question about it. Are we going to power into the end of the year? I would think so. There's lots of analysts now calling for SPX to be marking at 7,000 by the end of the year. So that is a very, very likely thing when we move into the last quarter of the year, especially since we've had such a big bullish year. Looking at NQ, we're down just 0.13% today and showing some strength. You can see this candle. If we zoomed in just a little bit, we would see this is a hammer candle. So we see quite a bit of action, but almost all of the action is at the very, very top. If this goes green, it will be what we consider a hammer candle, and it will move us green for the week. So looking for that. Russell up 1.64%. And again, same sort of thing. We're seeing quite a bit of action. We've got a long wick to the downside. We're currently marking at the day's highs, and we're moving up into territory where we're at the top of the Bollinger Bands. I mean, I don't for any reason think, oh, we're just going to power through just because. I mean, when I'm putting on plays in this kind of market, you guys know that what I'm doing is I'm targeting max profit in this lower area where we might see a move down, and that's where I want to see my max profit. I don't mind taking profits if it continues going up, but I want to protect my account in times like this. So you'll see a lot of trade setups today where I'm looking for that downside protection. Dow Jones Industrial, I know we don't cover this a ton. This one, we're not at recent highs, but again, moving up. VIX still kind of bid. We're at 19.25 today, up 1.6%. When the VIX is above this red line, which is currently sitting at 17, this means we have above average VIX. This is time where we sell premium. This is when I want to sell short puts. I want to sell short calls. I want to put on diagonals. I want to put on put spreads, things like that. But what I'm doing is I'm not trying to get into positions where I think stocks are way too high. Things like oil has actually dropped out of the bottom of my sweet spot, which is fine. I took profits the other day. My patrons know that. Had a nice return on capital over the last month and a half. When we were up here, I was doing nothing. I was waiting for oil to come down into this range. This green range between 60 and 64 is my sweet spot for entry. Now, when we get below that, that's even better. It's even better. There's pressure to the downside on oil. I don't expect oil to go ripping up, but I almost never play unlimited loss on oil to the upside, because if there's a world event, oil can just rip our faces off. Oil can go over $100 a barrel in a second. Well, in a couple of hours usually. But if something happens, oil does tend to pipe up. When I'm looking for oil plays, we'll take a look at Moomoo and we'll see what we can do if there's a play. But this is an ideal time to enter when I believe when oil is under that $60 a barrel. And it's just because I've been playing it for a very long time. You know, if you went back and looked at my trades, you would see that I would have entries every time we get super, super close into this range, into that $64 a barrel. That is my prime time to enter. I entered some here, and we make a little bit of money on those trades. Now, gold still going up. It's absolutely astronomical. How crazy is this rocket ship? We're just going up and up. And is it going to stop? Possibly not. We just don't know. Silver, same sort of thing, seeing that to the upside. Apple just slightly down today, but again, top of the Bollinger Band. So when we look at this, you know, my target for these areas are down where the recent trading range is and where the VWAP. So I'm always looking at that. AMD, we saw this news with OpenAI last week. The stock was way, way up. Again, I have all my bets that AMD is going to be dropping lower right now. That is, I'm not short AMD, but I am definitely leaning to the short side. I think it'll retract a little bit. ARK, we saw it pushing outside of the Bollinger Bands. It's now come into that. We're outside of its trending channel. So these are very, very high. I like to play them to the downside. Then I also like to look for outliers. So we see things like Adobe where it's already, this is a tech stock, but it's down at the bottom of its Bollingers. This is where I might take a slightly bullish play. Coming up to earnings here. Look at how many earnings beats. Beat. These are all green. Adobe beats on every single earnings, but the stock is trending down. Pretty interesting. Due mostly to competition in this space. Amazon has a little less competition, and it has been beaten down recently. We're at the, my phone is ringing. We're at the right at the VWAP, and looking for positions that may make a little bit of money to the downside. I like to play around the 205 for Amazon for my target zone when we're trading where we are right at 217. I play those types of trades when we're up at 240. I made a tidy little profit last Friday. I play short duration looking for that 205. So I'm giving away all my secrets today, it sounds like. We got a couple questions. Paul Bass says, currently in my portfolio, I'm using cash, about 25% in 1 month's CDs, paying approximately 4.1%. Is there a better way to make that cash work, but still keeping accessible like it is in 1 month CDs? So I don't use anything that has locked in. It depends on who you are or where you are. You're Paul, you're from Arizona, you're American. Lots of people use Bill, B-I-L-L. Let's pull up Mumu and we'll take a look at B-I-L-L right now. But that is one of the kind of easy 1 to 3 month. So these little guys, if you go back in time, they basically can be cashed out anytime. Look, the way that these function, they basically go up in value daily. So we can see it's a little bit weird on this particular chart, on the candlestick chart, but they basically pay out a dividend, go back up in value, pay a dividend, go up in value, pay a dividend, up. You get the idea. This is where most people just park their cash, BIL, and very easy, very liquid to get in and out of that. So $91.58, and literally can just get out of this any day. It just pays a consistent return. What is the current return right now? If we were to look at the profile, what is so the dividend is monthly. Well, I guess we can just figure it out, can't we? Where's the dividend payout is 32 cents a share, 31 cents. So the most recent one was 31 cents a share. And if we pulled up the calculator and took a look at that, we would be annualized would be 0.31, 0.31 times 12 equals, and then divided by 91.58 if we were to get into that today, and we would be seeing a 4% return. So it's effectively the same as what you're getting right now, 4.06 compared to 4.1, and can be cashed in daily. So that's where a lot of people park their things. And yeah, and you find it, so Paul says he finds it surprising that AMD is valued higher than NVIDIA. I mean, the big thing about AMD right now is that there's this crazy OpenAI contract that basically says if If the stock goes to $600 a share, they're able to buy shares at 1 penny. And there's quite a bit of valuation there. So there's good incentive for OpenAI to help drive the stock price, but AMD's trading at 223, massively, massively high. I would love to know, our shareholders, like our insiders buying, selling, what's going on there? You know, the majority of the holders are other, 72%. So lots of insider holdings in AMD. Vanguard, BlackRock controlling about 17% just between the two of those. So there is a lot of private sector, or private individuals holding stocks in there. And see, Juan is saying hello. You guys are amazing. Thank you so much for the likes. I see I've got a couple of those already, so I appreciate you doing that. If you've got questions, just drop a ticker down in the chat room, and I will take a look at what is going on. I've got alarms going off all over the place. Today I'm getting my driveway resealed, so the guys are just showing up here to get started. I knew they were coming, but we're getting into that. I really, with AMD, how I would play this is I would look for plays that make a little bit of money to the upside. Here, let me show you how I would play this. Let's pull up Moomoo. Let's just go to the options. If I was going to build something here, let's go to the options chain. We've got October 17th, which is only a week away. We've got October 24th. There's plenty of value on the puts. So let's just say we were buying or selling a 172 put. Now the risk on this is that the stock drops quite a bit, but if it goes up, I make $172 for selling that put. So if we looked at the curve, it's relatively small reward for a great risk, which is what small or short puts are in general. They work extremely well. They pay out very well. Max loss is almost $20,000. Max profit's $174, but it's got an 85% probability of profit. Now, how can we make this a smaller bit of capital, so to speak? Well, what we can do is we can just go to the table. We can go out a further week, let's just say 17 days, and we look at that, and we can buy a further put. Now, we're basically using some of that money. This is the 200, and I'm collecting 175. So what if I was to use the bulk of that money to buy a put? What does this do? Well, it gives me a net opening credit of virtually nothing. Price is 15 cents credit, so it's pretty small. But when we look at the curve, let's just look at what the max loss on this is. Now, all of a sudden, we've got a 87% probability of profit, a max profit of $271, a max loss of $1,249, and the break even of 196. So we're effectively getting ourselves in a position where we're risking way, way less. The nice thing about this is that if there was a volatility expansion, these are relatively close together, there's actually a little bit of tent covering. Now, this IV expansion tool doesn't, it says if IV expands to 327%, then, the break even is gone to some like super low number, 143. That's super unrealistic, but there could be some expansion for sure. And if AMD did sell off, say it all of a sudden was trading around that 200 level, well, there's a chance that this stock this position could make a substantial amount of money, $600 or $700 if we were close to that short put. And so these are the types of positions that I don't mind taking when I want a small max loss and a great deal of potential if the stock goes down. Now, what happens if the stock goes up? Let's talk about that, because that could happen. What if in a week or in 10 days, the stock is trading at 223 or 230? Let's just say it's at 230. Well, the short put, the October 24th short put expires worthless, and we still have the long put. Now, this long put could be way out of the money. It could not be worth anything at all to close, but we got a credit to open this. So if it does go up, if the stock goes up and up and up, we started this with a net 15 cent credit. And once this short put expires, we end up with the position where we're just long a put. We can either let it expire for nothing and we've made 15 bucks on the trade, which is relatively small, or we can put ourselves in a position where we can sell it off. And maybe Maybe we take another 15 cents, or maybe we take 50 cents out of it. This is making a bigger return. And that's why this profit slope is the way it is. So these trades have a fantastic ability to make money. Now, if you guys were around Friday, and when we saw that market sell down, let's just go over to the what happened on Friday. If we look at NQ, we got into a position. I'm trying to zoom this in here a little bit. We're gonna, how am I gonna do this? I'm just gonna zoom into what happened on Friday. We're gonna look at these candles because I had a bunch of these positions on. And if we were to kind of expand this up and take a look at what this chart was looking like. So I was putting on positions like this the whole time. Every day I was putting on new positions that were targeting lower than the current price. And a lot of these had an expiration on Friday. And it's nice to be able to brag about how big the returns were on Friday, but I had like multiple positions that were paying out way more than max profit because this candle happened on Friday, and it just pumped my account up. So when everybody else was having a sell-off, I was like extra green, and it was fantastic. And that's what I like to do. These are those days that you're waiting for, that when they happen, you're just like, cha-ching, that's an awesome win. And now, where am I today, back on Monday? I'm putting in those new trades. You know, I've already got a couple more of these, and I'm building them very specifically. I'm building them on positions that are going to potentially pay if the stocks drop into that zone. And if they go up, oh well, I make a small return. The week before, I actually had a few that were losers. The market had run up so much, I had paid a small debit to enter them rather than getting a credit to open. I prefer to get a credit to open when I do diagonals, but sometimes we get small debits, and those create small losses. That's fine. That's fine as long as we have a profit tent that's big. Let's go back to Moomoo for a second, and I'm just going to show you what would happen if I made this tighter. So in this case, this is selling the 200 and this is buying the 187. And if I did like the 192, what's going to happen is it's going to increase the tent. The profit is actually increasing, but we're adding risk to the upside because this actually costs 40 cents. So if all of a sudden AMD went screaming upwards, I could be out 40 bucks per contract on this. I'm risking way less. My max profit is now bigger than the max loss on this trade, and I still have a 65% probability of profit. If we go really, really tight, and this is something that we can do. So if we have to do a calendar, now we have virtually no max loss. So let's just take a look at what this is. We've got the 167 max loss on this. If we were to get into this and pay 153, but I have considerable upside risk. If AMD rallies, I have to be able to sell off this 200 put once this October 24th expires. I have to sell this 200 put for at least 153 to get back my money. But there's something interesting we can do here, and this is what we can do is add extra calls, or sorry, extra short puts. So if we're in a position where we can afford to buy 100 shares, what I might do is I might do this as a ratio. I might sell 5 and buy 4, and by doing that, you'll see what happens. We end up with a contract cost of 440 bucks. But what I have is I have 5 short puts decaying, and I have 4 long puts decaying. I get the benefit of having a position that makes quite a bit of money. You know, my max profit is now $5,000. My max loss is $20,000. So I can make a quarter of my money if the stock was to drop to that 200 level. This is an extremely lucrative way to trade. I have massive positive theta decay of $35 a day in decay. So if the stock doesn't move, let's just say it sits there for the next 10 days and doesn't do anything. If volatility doesn't change, the price doesn't change, this thing makes 35 bucks a day, and I'm left with a profit of approximately 600 bucks for taking on this risk. This is extremely, extremely lucrative type of trading. The bigger the ratio, the bigger the upside potential loss is. So if I did this, say I did like 2 shorts and only 1 long, if I did a 2-to-1, then I don't have as much max profit. It's only 1,300. I still have a $20,000 loss, but I'm also only paying, like in this case, I'm getting a credit. So I have no upside risk whatsoever. If AMD goes up and up and up, I have nothing to risk. So that's the cool thing about these. If we can do a ratio diagonal using calendar spreads, we can make these the adjustment very, very easily. And we can say, here's a position. I've got, $20,000 of risk. I'm entering this trade for a debit of 128. That's all I have to get back from selling these two puts in order to make money. But now all of a sudden I have the potential of making 2,500 bucks on the downside. Still 62% probability of profit. And if IV expands, the tent gets theoretically a little bit wider. So that's kind of one of the fun things about having that. Let's get to some questions. Juan's asking, what do you think of Melly? We'll take a look right here. Take a look at the expected move. And then we've got a couple of questions. Fank's asking, too late to jump on that rocket. I definitely made some money on it. I don't know if I would be particularly, jumping on right now. I don't like to jump onto things like that. It's there is definitely times where we can, but we'll take a look at the chart. And and then Jimmy Traders has a question I will get to as well. So let's look at the Melly, which is Mercado Libre. I actually don't even know what they do. I've actually traded this stock before and I don't even know what they do. How terrible is that? It's an online commerce platform focused on e-commerce and related service. Brazil, Argentina, Mexico, other countries, Chile, Costa Rica. So are they Spanish speaking? Are they Portuguese? What's interesting? That valuation is crazy. Minimum. So stock's trading at 21.79 currently. Strong buy rating. 86% of analysts show a buy. 13% say a hold. 0 a sell. If we look at the price targets, Morgan Stanley's pricing at 28.50 to 28.50, Citi 28.50 to 2700, BTIG 2700 2700, JP Morgan 27 to 26. The minimum is 2600 for a stock that's trading in 21.79. Average is 28.68 and the max is 3500. This is exactly the type of thing where what I might want to do is get myself in a positive theta decay position where I can make some money. I'll show you how I like to set up trades on stocks like this. What I do is I use a bit of, I'll use some leaps. And I don't like to go super far out. So you can if you want, but going out, I feel like going out half a year is plenty. And what I might do is I might buy some calls. So, and I can buy these like even right at the money. Let's just say I was to buy 3 of these. And then I went to a short duration date, like the 31st, 17 days away, and I would go above the current price and I would sell a couple of contracts here. So I'm buying the 2180 and I'm paying, quite a bit of money for that. I wish the Moomoo showed how much we were paying for the actual contracts without having to go onto the chain. But let me just close this down here so we can go and take a look at it. I'll collapse this. So we're collecting around $95 per contract to sell one, and then to buy the March. We're buying those for 26,000. So if we bought 3 and we sold 2, this is what I'm trying to do. Let's look at the curve. What happens here? We have a max profit is unlimited. We have a 62% probability of profit. We have positive theta decay of $390 a day. We have if the stock goes up, we make lots and lots of money. Is it as fast as if I own the stock? No, it's not. But it's also not as much money. This is a $56,000 trade. If I was to just buy 100 shares of Melly right now, it costs me $217,000, and I would have no positive theta decay, and I would have upward potential of making 100 delta. That's how much I would get. Well, this trade gives me 70 delta. So I'm getting upside potential of 70% of buying 100 shares of stock, and for a cost and a risk of only 56,000. So for a quarter of the price, I get 70% of the upside. Now, of course, this is slightly dynamic. You'll see that if we zoom in on this, that dotted line, that's kind of the important part to look at. Maybe I'll just collapse this down. Maybe that'll make it a little better here. That dotted line is how the dynamic delta would work. So you can look at the slope. So that's the thing that's important here. So if I was to draw some lines on here, let me draw a line on here. Let's just say I was like drawing a tangent line at that point, and then I was drawing a tangent line at this point. See how those slopes are slightly different? And then up here, we get, I know this is pretty subtle, but this slope is steeper than this slope. So this trade, it has a dynamic delta, which means it's 70 when we're going up here. And as the stock price rises, let's just say the stock price went to 2,500, it would still be positive, but it would be less positive. It would be losing ground. That's why the curve is kind of flat here. This is an extremely lucrative potential play. Let's just say the stock doesn't move. Well, at expiration, from here, if I was to zoom in, if the stock doesn't move at expiration, this trade makes $16,000. That is a massive, massive return. And of course, it's theoretical, but this is getting positive theta decay of, how much did we say? $395 a day. Theta right here, 395. And this is, the 290 calls are October 31st. So it's the 14th. We're like 17 days away. 395 times 17. That's kind of the math. Boy, I've got a busy phone today. Let's just run that math. 395 times 17. $675. And so we are not, that 17 days. This is, the true value will be $6,700. The theoretical is $394, but it doesn't always work out that way. I like to use 4 to divide what we're actually going to get. So let's just say 395 times 17 divided by 4, and then that will give me a more realistic return on capital. So about $1,678. So either way, massive, massive potential for a stock like this if you wanted to get a bullish position for much, much cheaper. Still expensive trade, 56,000. Bank, let's just pull up UUU. Let's look at how crazy it is, but it is pretty crazy. So energy fuels, we're seeing that hammer candle. I talked about that earlier. So this is exactly what we've got, a long wick, lots of trading range today. Everything's trading at the top, very small wick on the top. This is generally bullish. Could it keep going? Absolutely. We don't know if it will or not, but 12% today, a pretty massive move. Jimmy Traders, have you ever heard of Conquest financial planning software? If so, have you ever used it? It's for retirement investment allocation and monthly income allocation. I have not traded it, never heard of it, so I will check it out. I'll put that on my list of things to look at. But thank you so much for bringing it to my attention. Paul, I have high hopes for energy, as do we all. I think that's already priced into the market. Energy is obviously something that's going to be moving to the upside for years to come, because there's energy required for absolutely every expansion that's happening globally right now. And Paul's saying energy stocks, energy funds, because of the massive needs of AI. Also, I think people are too focused on NVIDIA and AMD, but missing out on data storage companies. We can see that already. They're not, I don't think people are missing out. I mean, you know, we were talking about Iran. I know we were buying Iran last year at $7 a share. It's 10x this year. It's now $70 today. So my patrons knew about that last year when we were buying these positions. You know, this is a company that's building data centers, and you know, if we're ahead of the game, that's where we make money. So has this already happened? I think there's lots of money flowing into those, And I think there's potentially still room to run, but some of these are gone up quite a bit. If we were to look at like the let's just look at IREN's valuation here now, because we knew when it was the $70 there was lots of potential to the upside, or $7 there was lots of potential, but now the fair value is only 45. That's 36% lower than current. Stock's trading at $70. So we have to play with caution with these particular stocks. You know, they could easily go down quite a bit, if that makes sense. Is there any other questions? Do you guys have anything to ask? If any stocks you want me to look up? This is investingpro.com or investing.com's pro edition. This is a paid thing, so I can look these up for you guys. If you want to throw some tickers down, we can look at like and we'll see what the valuation is on that. And it's fair market value currently 1551. This is one of the ways that I assess companies daily. I will not take a trade without looking at investing.com. And one of the things that I'm looking for is making sure that I don't get burned on these. It's fantastic that it's up 1,500% in the last 5 years, and it's up 365% this year. And in the last 3 months, it's up 280%. This is fantastic. But what's a fair value for this? If the fair value is $15, then at some point in time, there's going to be profit taking and these companies are going to come back down. So are they just playing the hype? Absolutely. And, you know, the smart investors don't get in when we're too high on these. You know, there's a top to all positions, and we just have to make sure we're on the right side of that. That's why, you know, I like to look at companies like Adobe, which are undervalued right now. Fair market value is 469. That's 38% higher than current. So if I was looking to buy stocks, you know, looking at these, we've got management aggressively buying back shares. We've got a high shareholder yield. We've got analysts upwardly revising their earnings, and they've got impressive gross profit margins. They're not exciting, you know, it's not exciting trading, but the performance is great. The price momentum right now is poor. So what I'm looking for is outlier moves. You know, I'm looking for, this is the last 3 months down 7.89%. These are stocks I want to get long. In the last year, it's down 33%. When this ticks up, when that money starts flowing out of IREN, when it starts flowing out of AMD, then I will be picking up the pieces. And you know, this happened on Friday. This is what I was saying about, you know, putting on trades that are smart, that make money to the downside. SPGI, yeah, absolutely. Let's take a look at it, Brian. Good question. SPI, SP Global. So this is capital market. Fair value 466. And so these are where I might take just a neutral trade on this. And we look at it's come down. This is again, one thing I don't love about investing.com. It doesn't show me a historical what they said about fair value. But if we look, let's just look at the 1 month chart. So it's currently at 487. Let's assume that this fair value has been 466 for a while. So if somebody was to look at this a month ago, and the stock was trading at 540, and they came on to investing.com and they looked at this and said the fair value is 466. I'm going to take a bearish play on this. I'm going to set something up that makes some money to the downside. Well, they would have won this month. You know, and this is how we play these types of trades. Now, the next step is that's step one, is finding out what my direction might be. This is pretty close. This is where I'm considering neutral trades. The next thing will be, how liquid is the stock? How many options do we have in here if we're going to play it as an options trade? You know, because it's easy to just buy stocks in this and buy when we can put in a buy order rate at 466, and if it fills, then great, and if it doesn't, then we've never purchased the stock more than the fair value. But let's go to Moomoo and look at what the kind of strategies they pull up. So SPGI. Oh, we're going to look at this. I've never played this before, so I don't know how liquid it is. But if we were to look at the strategy builder, it's going to show the short straddle. This is for October 17th, which is only 3 days away. The expected move right now is the profit. If you just look at the straddle, if we sold the short 287.50 put and sold the 287 call, we'd get $1,000, which means we have about a $10 move to either side. So let's just put that expected move in here. That's $10. and we'll see why some of these trades are pulling up the way they are. So we've got the straddle. This basically makes money as long as it stays inside of the expected move. Short strangle makes a little bit of money in between that expected move. Long call butterflies. These have high returns. If you compare these trades, like this trade takes $40,000 in capital and it has a profit of $1,000. This trade has a potential profit of $1,000, but risks 710. So when we are building an account and building a portfolio, it's great to have one or two of these on. This is great. This is pure theta decay. But these trades are the smart trades. You know, this trade has a return on risk of 142% compared to 2.5%. This is like a massive return, and we can hit some of those. It's great. Now, we can put in diagonals in Moomoo, but it doesn't pull them up automatically. So this is just like our neutral trades, and you'll note this 477. Now the valuation that we were looking at on investing.com was actually 466. So what I want to do is I don't ever want to be in a situation where I am losing money if the stock trades lower than fair market value. I think that's a fair thing to do. So what I do is I go into my option chain and then I start building things out. So I go to the curve and I might look, oh, there's earnings coming up on the 30th. So I might go to the October 24th and I'll say, hey, what if I sold that to that 470, which is slightly above. If we look at this curve, you're going to see the break even is 467. It's just $1 above fair market value. So if I was to buy those shares, I'd be buying them at an extremely good deal. 80% probability of profit. Now, this is where those diagonals come in. So if I go to the October 31st, which is after earnings, this long put is going to maintain a ton of its value because earnings are going to be coming up. So all I have to do is look at how much I'm getting. I'm getting $2.80 to sell the 470. Well, I want to pay around that value, very close to that value to build a diagonal. Now, this is 15 points wide. So I'm going to have whatever I pay, which is $95, plus the width, which is $15 in this case. So we got $15 between 470 and 455. That's what gives us our max loss, because the maximum loss would be if the stock went crashing down, went to $300 a share or something crazy. I have to buy this spread out for $1,500, and I initially put in this paid 95 cents for this. But when we look at the curve, these are great trades. They look pretty flat, but there's a few things that I really like about them. A, they've got positive theta, so as time goes by, I get paid. The gamma is very low. The vega is very low. So this means and the vega is actually positive as well on a trade like this, which means that if volatility expands, IV is currently 32.5. If the IV expands, then this profit tent gets wider. Look where that break even is, 466, 421. Now the problem is the break even on the upside. It's the 486. So we have to be concerned about that. We have to say, well, am I okay risking $95 if the stock goes up? Am I okay losing to the upside? The risk is definitely not to the downside. I mean, if the stock goes up, that's when we're going to lose. And then this is where I like to play, maybe one of these as a spread. I'll show you how to make a really, we'll do like a little diagonal with this. We'll do 6 short and 5 long. Let's just say that. So we're paying the majority for these. The price on this now is $110. That's how much upside risk I have on. But if these all expire worthless, I have 5 put contracts to sell off. I would only have to get just over 20 cents each, 22 cents each to sell these off to break even on the upside. So there's virtually no upside risk. If the stock moves down, there's IV expansion. This tent gets wider, which is nice. I like that. If it goes up, I'm not making very much money to the upside. But I have massive maximum loss now, $54,000, because one of these short puts is naked. So what if I just define the risk of this 470? What does that cost? Let's go to that table. Let's look at that October 24th date again. And remember, I've sold the 470. Well, I can just buy the 440. Just buy one of those. Now I have everything is defined. I have 6 long and 6 short. So all of a sudden my max loss is $11,000. My max profit is 2,000. I have a 35% probability of profit, but I'm also paying $408. Spreads are not very wide in this. We can't get super fancy on trades like this because there's not enough volume on these. The spread, and when I'm talking about spread, the price difference between the bid and the ask of the 440 put for October 24th is, the bid is currently 5 cents to buy and the ask to sell is 470. It's not, it's pretty wide. What we want is really liquid options. Are they tight enough even here? Not super fantastic, you know. 340 to 470, that's $1.30 theoretical. If you were to buy and sell in the same minute, you would lose 110 bucks just by buying and then selling at the current prices. So you have to make sure we get into very good prices on this. If I was to only buy, you know, that 440 put for 30 cents, then that would be a nice little entry. And then my curve, now you can see my max profit is much bigger. My max loss is still 11,000. If the IV expands, then my max loss gets bigger. That would be the ideal, is that this goes down, IV expands out as the stock goes down, which is why I love put diagonals. And I especially like put diagonals in this market, if that makes sense. ELV, let's take a quick look. And then I'm going to go out and see how these guys are doing on my driveway, because you pay people to do stuff and you want them to do a good job. So I got to kind of babysit them a little bit. It's one of the nice things about working from home, is that I get to do that stuff. Price right now, 350. Fair value, what is this? Healthcare service and provider. Fair value, 494. Management, aggressively been buying back shares. High shareholder yield. Has raised dividend for 14 consecutive year. Prominent player in the healthcare provider services industry, and great performance. Stock is way up in a month. We've got 3 months, 1 year. Thank you very much, Brian. Appreciate that. Look, I'm grabbing a pen. I'm writing this down. I love when this happens. This is why I do this, because we're all trying to get rich together, right? Isn't that the thing? If you guys are trying to get rich with me, you know, say something in the comments. Let me know. Which stock you're trying to get rich on, because that's what we're trying to do, is share knowledge so that we can get rich together. I share my knowledge of how I might do something with options and how to give myself potential upside while creating theta decay, limiting my loss to the downside. And you guys get to help me by saying, hey, have you looked at this stock before? I'm even going to pull it up here on. I'm going to pull it up on TradingView, and we're going to take a look. And is this it? Elevance Healthcare. Like, what is this stock? Okay, wow, we're way down at the bottom of the Bollinger. 20. Well, this doesn't look as exciting. I mean, it's down. Well, why is the trend so hard to the downside? What are they doing? We got earnings coming up. On Tuesday, the 21st, that's next Tuesday. Revenue 49 billion, and I'm just going to look at Moomoo as well for this. You know, do a couple of different ELV, and then we'll look for an earnings play and how I might play this. Probably, I would actually prefer to play these after earnings. Minimum 310, average 377, and max 345. And we got buy. We got Morgan Stanley upgraded. We got a couple upgrades. This is one of the things I'm like loving about Moomoo. It's just like this type of data that you normally pay for. Like to get that data on investing.com, I'm paying for this. This is like a out-of-pocket expense to make sure I have this this data on the investing.com Pro. Moomoo has it, so it's pretty great. Now 350, let's look at the table. It's earnings, right? So earnings are coming up on the 21st. We've got one expiration cycle. I mean, if I wanted to get in, what I would do is, like, if you want to buy positions, the easiest way is to buy calls, and then you have max loss built in, and you know, you don't have to be crazy. You can buy ones that are out of the money. it's cheaper. So what if we did like 4 and 3? And what does that look like? So in the curve, we're going to have positive theta decay of $191. We've got some relatively little gamma risk. We've got positive vega, which means that if the volatility expands, we get, this helps the trade. Max loss is 14,000. Max profit is unlimited. Break even is for 347. Stock's currently trading at 350. So it's similar to going long stock. This is like a form of poor man's covered call, except what I'm doing is I'm using a ratio. I'm buying a few more than just one, and that gives me a higher delta. This actually has a 132 delta, so it's the equivalent of buying 132 shares. Now, if I wanted to buy 132 shares, this trade would cost me 35 grand. Well, I can get into this trade for $14,000, so half the amount, and I have a higher delta. Great if it goes up, sucky if it goes down. So how do we change that? Well, we sell more. You know, I can change the delta pretty easily by just selling the 360s. This will make it much more neutral trade. And it depends on how much money we have. This is giving us 165 bucks. So we're getting a little more theta decay. And if the stock stayed in this range, say it just ran up to 360 over the next couple of days, this could make a couple of grand. Like, this is a nice little trade. It's got lots of positive delta. But it actually is by doing this, the 5 to 4, by selling more than purchasing. Now what I've done is I've created a more neutral trade. So the delta actually becomes negative if the stock went up too much. So if the stock went screaming up, it would actually turn negative. And poor man's covered calls, like if they're even, if you have like 4 and 4, then they have slightly positive. Depends on how far in the money the long is. In this case, I've got the 370. I actually, if I want to get long, I usually buy these out of the money. They're slightly cheaper than, you know, poor man's covered calls to me. Like, say you're buying the 310, and people are like, yeah, look at this, I'm buying this. They're actually taking a ton of risk. You know, this is, let's just do one of each of these. Let's look at a poor man's covered call. Sure, you get more delta out of it. The delta is 47 on this. And the price is $6,700. So you've got $6,700 in max loss, and you got $894 in risk. Well, let's just go up and watch how much this max profit changes relative to the max loss. So from a return on capital, let's just say we made max profit at 894. Let's pull the calculator up again. Let's just do this. So let's go 894, and then divided by 6,700. We're going to just call it 6,700 even. 13.3% return if it was hitting max profit. Well, if I, instead of buying the 310, if I just bought like the 350, max profit is still 869. Max loss is now 435. So my calculator, let's just do that math. So 869 divided by 44.35. Well, I've got a 19% return on capital if I hit that same short put, if the stock runs up to 360. And do I have a lot more upside risk? Not really. I mean, this is still super profitable. If the stock was to go up, you know, I'm profitable as long as it's below 386. And I would rather have that. I would rather have less risk, higher potential return on that risk. Also, the theta decay would be higher. So theta on this is $66 per day. And if we go back to that 310, the theta decay on this is, the theta decay is all coming from the short call anyways. So buying the 310 and the 350, the people are like, well, we buy it further out, you get less theta decay because you get the 310. Well, let's look, $67 compared to $66 a day. So for $1 a day more, I would rather have $2,000 less risk in my account. And we can take even less risk. I mean, you can do the 390. Look at the theta on that is 66. The problem with this is that the delta isn't as high. This is way more delta neutral trade. And this is where we increase that number of contracts. We go that 5, and then we just buy 6 or 7 of these guys. And so now when we look at that, we're gonna have a max loss of $20,000. We have huge theta decay. We have 189 delta, and instead of $35,000 trade, we've got a $20,000 trade on. And it's still bullish overall. Still needs the stock to go up. I hope that, does that make sense? I hope you guys are able to follow some of that logic. If not, just go back and rewatch, and hopefully I've covered that. Would you ever consider PZZ a nice dividend? Easy money. Thanks for that question. I wouldn't. I don't love the product. How much is the dividend? I mean, if I want dividend stocks, look, I could just PZZA because that's pizza, right? Oh, it's Papa John's. Papa John's slightly better than pizza, but dividends. What are we looking at here? If it's 4% dividend, I don't know. Like it, you know, when I look at this payout ratio, 80%. There's so many companies that pay such a huge dividend yield. If I want dividend yield, I'm kind of in the like, let's get a crazy dividend. Let's get a crazy dividend and see what happens. Because when we're getting a massive dividend, then I can really make some money to the upside, if that makes sense. Because I'm just making so much, which is what we're trying to do. We're trying to get rich together. If you guys haven't checked it out, head over to drawbridgefinance.ca, sign up for my newsletter. I'm sure most of you are on it because you're already subscribers. If you're not, I send out a weekly email, shows the type of trades I'm putting on, and you know, encourage people to come over to the Discord and join that. There's a free level there if you want to like really amp it up and you want to see what trades I have on. You can join that, which is fantastic. Then we can chat about all this stuff. I'm online. Generally speaking, I'm online during my during market hours. Even though I've been trying to really have like as much of a life as I can. You know, I do this and I spend a bunch of time with everybody because I want to give back to the community, and I love talking about options. And if I can make people make some more money, that is fantastic. If I can help them, so that's why I do it. But at the same time, I have other things going on in my life too. We're all busy. That's why we're investors. We make money so that we can buy back our time. And that's why I'm here doing this with you. So thanks so much. I appreciate the likes. I appreciate everybody here. You guys are fantastic. I'll see my patrons on Thursday, and I will see everybody else next Tuesday. Let's get rich together. Take care. Bye.